we got our license to start a mutual fund in July of last year. And September, we launched a few schemes, September, October of last year. And in November, we applied we applied in September for a SIF license. And we got the SIF license in November. It's, oops. Some of these things are opening up, I guess. Yeah, it's fine. And no, it's fine, it's fine. No, it's fine. You don't have to do anything. Perfect. And I joined the wealth company from Bajaj Alliance. So I was working for Bajaj Alliance for the last, for 14 years before that. I was managing over 50,000 crores worth of hybrid funds, both on the shareholder side as well as on the policyholder side. And we applied to SEBI in September and we got approval in November, but we did not launch the product because we were still working with fine-tuning our models, working with strategies and frameworks, etc. But now we feel that this is the right time that we are ready to launch the product. It's taken us, it's taken us some time to create that entire framework and strategies, etc. But now we are ready. And we are coming up with two products on the SIF side. The first one is kind of a flexi cap product, which is called as WSIF Equity Long Short Fund. And the other one is on the mid and small cap side, which is called as the WSIF Equity X Top 100 Long Short Fund. How many of you are generally, just with a show of hand, how many of you are aware of SIFs generally? SIFs, all of you have cleared SIF exams? Started selling? Not yet, okay. So what I'll do is I'll quickly brief about SIFs, what they are, and what our strategy is going to be, etc. And hopefully can take some questions from you guys. SIFs fundamentally are very similar to mutual funds. There is nothing that a SIF cannot do that a mutual fund can do. It can do everything that a mutual fund can do and something above it, more than that. Unless you have a mutual fund license, you cannot get a SIF license. And all the regulations, all the kinds of disclosure standards, portfolio level disclosures, etc., which are applicable to mutual fund schemes that you're aware of, everything has to be followed in the same context, even with respect to SIFs. All the resources, that is on the research side, on the sales side, on the operation side, on the IT side, everything is fungible. So we run a common team among the entire mutual fund and the SIF teams. And except the fund manager, which is myself, or I'm the CIO, and a couple of guys who are going to help me in the SIF fund management process, the dealer, etc., everything else is going to be similar. But obviously the strategies are different because the products are different. And so today I'll talk about the X Top 100 fund. So the first slide is about what SIFs are. So basically everything is SEBI regulated. You need an AMC, you need a custodian, you need a trustee, all the auditors that are typically required. So everything that is needed in a mutual fund is required in the SIF as well. And the advantage is that you are, the key clincher is that on the derivative side, an SIF fund manager is allowed to take directional bets using derivatives. So in the case of a mutual fund, derivatives are used primarily for hedging only. In the case of a SIF, a fund manager can take directional bets. That is, he can express himself on the negative side as well using derivatives. That is what differentiates SIFs from mutual funds. There are 7 strategies that SEBI has proposed so far, 3 on the equity side, 2 on the hybrid side, and 2 on the fixed income side. On the equity side, the 3 strategies or the 3 funds that are proposed are something on the flexi cap format, one on the mid and small cap format, and the third one is on the sector rotation fund kind of a format. So wherein you can take exposures to 4 sectors maximum at any point in time. And you can be either long or short the sectors, but not both. And obviously, the ticket size is going to be 10 lakhs minimum, so which is between the PMS and mutual funds. So any PMS holder who is not able to afford a 50 lakh ticket size can effectively participate in SIFs as well. These are some of the key differentiations that we have highlighted on how SIFs, MF, PMS, and AIFs differ. The first point is that in the case of an SIF, the minimum ticket size is 10 lakhs. In the case of mutual funds, obviously it's nothing. And in the case of PMS and AIF, it is 50 lakhs and a crore. The beauty is the taxation. So despite the usage of advanced derivative strategies or advanced FNO strategies, the taxation in the case of an SIF happens at LTCG and STCG, which is similar to mutual funds. So it is very much at par with mutual funds when it comes to taxation. In the case of AIFs, running similar kind of strategies, however, the tax rate is very high at 43% odd, and the taxation happens at fund level. So basically, the fund deducts the money and pays the tax and returns the money, which is balance post-tax of 43%. Now, this is after you have, whenever you are using derivatives primarily. The final difference and the most important one between, particularly between PMS, MF and SIF is that you can use derivatives. You can use unhedged short exposure to the extent of 25%. And there is zero leverage allowed, which is the beauty. So whenever we hear about derivatives generally, what we know is that people lose money in derivatives. But that's primarily because of leverage. So let's say someone has 1 lakh rupees and he is able to take exposure of as even 1 crore rupees at any point in time using options. And that is what the major problem is in derivatives. So SEBI has technically capped the leverage at 1x, so you cannot lever the product using derivatives. Whereas the best part about derivatives, which is risk management and risk control or risk optimization, is possible. So the best of both worlds, that is no risk on leverage part, but reduced risk at portfolio level using derivatives, especially on the short side. So that's the two best things that are possible in the case of an SIF. These are some of the advantages that we feel that long-short funds offer over traditional long-only funds. So if you look at the first point, it's basically in a choppy market or even in a bad kind of a market that we are seeing typically in current circumstances or during COVID kinds of situations or any kind of a GFC kind of a situation or a war-like situation. If the fund manager gets the views right, again, then potentially you can generate positive returns even in negative kind of markets or bad markets. So again, the key word here is potential. The SIF is equipped to take those decisions. Then it is left to the fund manager to be right about those decisions. But the SIF as a product is equipped to take those kinds of decisions. Given the long and short nature of long-short funds, typically, you will see that the portfolio level volatility can be managed better because the short positions and the long positions typically offset each other, given that there are always a certain correlation or a covariance among these factors. So I know this is a slightly technical discussion, but but stay with me. There is a reduced volatility and beta at portfolio level when you're running a long and short kind of a position. And typically, if the short positions and the long positions are able to deliver similar kind of returns or better returns than the market, then you're looking at superior risk-adjusted returns automatically. So you look at typically higher higher Sharpe ratio, higher risk-adjusted returns, etc., and which is generally better for the investor. And obviously, during sharp bull runs that we have seen in the past, wherein the market rallies by more than 50, 60, 70%, in those kinds of situations, there is a potential that a long-short fund or an SIF fund may underperform the long-only kind of a market. So now we have to think about what is the probability of that kind of an event happening. And but yes, I mean that's a fact that if there is a long and short position running always in the fund, then in those kinds of extreme bull markets, a long-short fund may underperform a long-only fund. Regarding why mid and small caps, I think it's well understood by by all of you guys since you are there in the markets for so long. But I'll harp upon the contribution to top decile returns point, wherein we are looking at, so let's say this data is, let's say over the last 7 and 10 years, if I just sort all the stocks in the NSE 500 by top decile returns, which are the top 10 percentile best performing companies, then you will see that 92% over 7 years have been belonging to mid and small cap universe. And over a 10-year period, that number is almost 89% or 90% kind of a number. So most of the times, mid and small cap is the universe wherein you are seeing the best performers always, and over a slightly longer periods of time. And obviously, it comes with slightly higher volatility, but if you adjust for the returns, then at sharp level, you will see that across time frames, that is over 5, 7, and 10 years, the sharp ratio of a Nifty mid and small cap 400 appears to be better than Nifty 100 DRI. What we believe is, obviously I'll talk about mega trends and what our core focus area will be. But generally what we have seen is that there are startups that start at a POC concept, wherein the proof of concept is not yet established. It's a new product. There are amateur investors and amateur promoters who start the product as an experiment. It gets to some extent funded by angel investors and venture capitalists. And it becomes slightly large in size, wherein the proof of concept of the product gets established. And then we see slightly larger PE firms, etc., participating in these kinds of companies. This is not the spot that we are investing, because these are still not IPOs. These are still in the unlisted space. The profitability is still lower. They are still loss-making. However, once they arrive at a certain size and they want some further growth capital, that's when they get listed as mid and small caps. And these companies typically, they show strong growth rates. The valuations reset from the otherwise hype of pre-market valuations. And obviously there's a focus of the management on profitability, on professionalism, etc. The return ratios are better. And when you see these kind of circumstances, we see that these companies typically become market leaders if executed well. So mega trends, generally they originate in early stage companies, and they're proven in the listed space, and especially as mid and small cap. And they enter the listed space as potential multi-baggers, and that's where you make the highest risk-adjusted returns on these companies, which eventually become sector leaders and large cap companies. This is about our fund. So our NFO started this week, and it will be ending on 29th of April. So we are launching 2 funds, one on the flexi cap and one on the mid and small cap kind of a framework. Our focus is on generating long-term wealth creation for our investors using equity. We do not aim to run a hedged kind of a portfolio. However, hedging may be used for certain events that are calendarized and well-known. But our focus will be on alpha maximizations from both long as well as short positions. This is our framework. I'll quickly walk you through this. So basically, we have named our framework cuboid. Every letter in the word cuboid stands for something. Q stands for quantitative validation. So, basically, we create a universe out of the listed space, which makes sense on return ratios, wherein we see that there is good management quality. They have delivered what they have been promising, where the return ratios are high, where the cash flows are strong, and there is no unnecessary dilution. There is enough number of data points to suggest that these are good companies. And these are some of the things that we wanted to showcase to you, but obviously there are a lot more factors that we consider in quantitative validation. This underlying mega trend, which is the U part, this will be the core part of our overall portfolio, wherein if you see, these are the mega trends that we've seen over the last 2 decades, which is about mobile phone and airline penetration, or urbanization as a concept, or nuclear families, or jewelry becoming formalized more and more. And these will be the mega trends of the future, and a lot of our portfolios will focus on these sectors, these themes, whether it is EVs or renewables or fintech or edtech, whether it is private healthcare, data centers, AI, machine learning. There will be all of these trends, which will be a core focus area for our fund. I won't know at this moment how much the portfolio will comprise of these names, but it will be a substantial number is what I can tell you. All of these themes are well thought about, wherein the trends, what I call mega trends, are already established, and they'll become stronger and stronger as time goes by. There is a lot of scope for these mega trends to still establish themselves and become larger in size, and the penetration levels, as you can see, the expectations are still quite high. So there's a long runway for growth in all of these sectors and the companies that will be a part of it. A lot of our focus will be on these companies. I'll skip through some of the points which are not important at this time, but let's say the investment hypothesis. So our focus will be a lot on quantification of the risk and the returns that we are getting from them. what is going to be the investment time horizon, what are the style factors that we are focusing on, and the market cap segment. So every stock which will be there in our portfolio will have a detailed investment hypothesis which tells you about what is the purpose of that stock in the portfolio, how much returns are we expecting over what period, what are the risks that we are carrying, and there will be an hypothesis that is built around it. Whenever there is a break in the hypothesis, we need to revisit our overall thought process. Along with the investment hypothesis, we also focus a lot on attribution analysis. So that is what has contributed to the returns of the past 1 month, what has helped us, what has hurt us, whether we need a revisit of our overall expectations and hypothesis. And that's an ongoing process that happens on a daily basis. And we believe that this is the right approach towards getting consistent alpha. These are typical portfolio stocks. I mean, it is a combination of emerging themes and high growth compounders, which will be the core part, which are always going to be there. And cyclical bets or contrarian bets or thematic momentum, etc., will be more tactical in nature. Our short positions also will be more tactical in nature. We foresee ourselves having a 10 to 20% kind of short positions most of the times on an average. There would be some times when we may not have any short positions. There may be some times when we may be net short in the market as well to benefit from any kind of potential downsides. At the heart is so there are 3 things that we'll be targeting in the SIFs. One is our benchmark is NSE 500. So from an investor's perspective, we aim to beat the benchmark handsomely. The second deliverable from a distributor's perspective is where our ranking is going to be. Among the SIFs and among mutual funds, we aim to be in the first 2 quartiles. And the third thing that is expected from a SIF fund manager is to have lower volatility at portfolio level, much lesser than the benchmark. So these 3 things are something that we are targeting. And if we deliver that, I think the fund should do well on all kinds of parameters, especially on risk-adjusted return basis. So that's broadly on the presentation. Quickly, I didn't want to spend a lot of time on this, but I'll be more happy to take questions on this if you have any. So strategy-wise, so let's call them as funds. So we are launching 2 funds. One will be like a flexi-cap long-short fund, and the other one will be a mid and small-cap long-short fund. No, it will be a mixture of all the 3 segments, large, mid, and small. But our endeavor is to have higher mid and small cap in that as well. There may be some large caps, but our focus will be more on mid and small. In case of mid and small caps, how do you hedge your exposure? Because is it not difficult to find the correct hedge for mid and small caps in derivatives? Yeah, so the endeavor within the mid and small cap segment is to generate long-term wealth through compounding effect, not so much to short and make money from that. Which one? It will be a mixture of, I mean, some of the stocks will be held on to maturity for a longer period of time because those themes may take time for entire thing to play out. And so yes, it will be, so the mega trend related stocks that I mentioned, they will be more long-term hold, buy and hold kind of strategy that we'll follow. So around at any point in time, 65 to 70% of our portfolio will be a combination of that. And balance 30-35% will be a combination of alpha maximization strategies, which is going to be both long as well as shorts. So what are the kind of alpha that we can expect out of it? So if I'm running, so if I am the fund manager who is running both a long only fund and a long short fund and applying the same methodology, in the case of a long only fund, the source of alpha is stock picks only. In the case of a long short fund, I have that alpha as a scope. Right? And over and above that, there is a layer of regime selection. So when I say regime selection, it means what is the kind of the market that looks like to be going forward. And if it's going to be negative, then can I make money on that side as well? So that is a scope for alpha maximization that is possible in the case of a long short fund or an SIF compared to a pure long only fund. So whatever I am generating on my long only portfolio, if I am running a long only fund, I should be able to deliver slightly better on a SIF. And the important point in this is it will happen at lower volatility. So the portfolio level volatility will be lower. So even if, let's say, the returns are similar, the volatility can be as low as 25% lower than the volatility of the long only fund. Sorry, just I'll come to you. So the naked shorts are allowed up to 25%, and hedging is over and above that as well. So you can hedge more than 25, but your naked shorts are limited to 25%, which will be a combination of both futures and options. And there's no compulsion for you to be short at all. I mean, it's a function of whether you find enough opportunities to short or not. If there are no opportunities, there's no need to run a short portfolio at all. And our portfolio strategy is that it will be a combination, both on the long side as well as on the short side. It will be a portfolio of stocks. It's not going to be one or two stocks or one or two sectors. It's going to be a combination of decent amount of stocks. We aim to have at least 50 to 70 stocks in our portfolio at any point in time, so that you are not caught on either long or short side on one single stock. Yeah. So typically, this is again as per me and our analysis, that a long short fund which captures cycles. So let's say a long short fund captures in the up cycle, protects the down cycle, again captures the up cycle and protects the down cycle. So the biggest benefit of that will happen once you've captured the full cycle, and a cycle typically takes 5 to 7 years. So the maximum effect you will feel of a long short fund doing better than a long only fund will be if you stick around for at least 5 to 7 years. Yeah. So as I mentioned, I mean, I think there was one question asked here as well. So obviously, stock selection alpha and regime selection alpha are the two sources of alpha that we have, compared to only stock selection alpha, which is there in a long only fund. And I think if I were to answer you in a different way, let's say, if you look at risk as a speedometer, right? And you are looking at risk from 0 to 100. In the case of a long only fund, which is completely invested, the risk is 100 out of 100, because every part of the portfolio is invested into equities, and equities is a risky asset class. In the case of an SIF, you can think that the SIF fund manager has a potential to fine tune the risk at what level he wants from 0 to 100. And that's the advantage, that you can effectively have zero risk, which is basically arbitrage kind of positions if you run, or you can go to the extreme right, which is full risk, which is what an equity mutual fund will have. So anywhere in between is also possible, depending on your combination of longs and shorts. So that's the beauty of calibration of risk that the fund manager wants to take in an SIF. Yeah. So on the short side, it will more be tactical in nature. It will not be really, really long term, because the maximum amount of annualized returns on the short positions can be generated if you are able to churn that kind of a portfolio more. However, that portion will be 10 to 20% in that region. So the beauty of the short positions is that along with generating the returns that we expect them to generate on their own, they also act as a natural hedge to the long portfolio, right? So that's the beauty. So short positions are, I mean, don't look at it just at 10 to 20%. They serve a very important purpose. And that's where SIFs actually come into the picture. Yeah. So as I mentioned, so let's say, so so the way we approach not just the short, but even the long side, is that what is the return I'm expecting from a certain stock, which is a function of earnings, which is a function of what is the conservative valuations you are willing to pay, and hence arriving at a target price. Now, on the other hand, there is risk that is involved, which is a function of the historical volatility of the stock, what has been the history, whether the stock is following a normal distribution or not, what is the kind of kurtosis. I mean, there are statistical ways of looking at things. What are these criteria that individual stocks are following? So what are the returns that they are following, and what is the risk-adjusted return on an individual stock? Wherever you see that the risk-adjusted return is going to be negative, those are the potential short candidates. That does not mean that you need to immediately short. There is a lot of quantitative analysis that goes into it as well along with it, because sometimes what happens is there are certain events or certain reasons why a stock is working, and you may not find it to be in favor, but these events keep going on and on for longer periods of time. So then there is a technical overlay or a quantitative overlay which is there, which helps us in identifying the timing also when you want to short these stocks. Not so much technical, but more quantitative analysis. Yeah. Sorry? Right now, no, we are not looking to hedge the portfolios because hedging में क्या होता है कि you do not make so much money on the money that is stuck in the portfolio. So if I'm running a in the cash and selling it in the future, I'm effectively making only arbitrage kind of returns on that part of the portfolio. So we are not looking to hedge unless we are scared about some event that is likely to happen. If an event is known, that is a calendarized event, whether it is elections or whether it is FOMC meeting or whether it is some other war kind of a situation or tariff kind of a situation which is known and calendarized, then you can go and hedge the stock. But otherwise, you are buying it from a wealth creation perspective. So I think no. No, that's not the way. That's not the way we are approaching this. So we are looking at from a. So this is not a speculative fund. We do not aim to speculate in the markets. Our aim is to be more sustainable, more consistent in terms of what we want to deliver. So those kinds of things, on a case basis, you'll have to look at. But it is unless and until they are a part of our core investment hypothesis, we are not looking to participate in these kinds of activities. See, it's a function of, I mean, if I could show you my sheet, it runs into hundreds of columns on the right-hand side for each stock. So there is a lot of things that we look into, and the decision to arrive at an answer or a solution to a problem, which is whether to buy or not buy a stock, is very complicated. And the complications are not from making it complicated, but to arrive at an answer objectively, to remove biases of the fund manager and arrive at these answers in a more objective way. Yeah. Yeah. So the product is similar. So there are like 45 flexi cap funds in India. So my fund is also going to be similar. My investment methodology, my hypothesis, my attribution analysis, the process that I mentioned to you, that's going to be different. The product is similar.